You've been told to invest your entire life. Nobody ever explained what it actually means or what the money does once it gets there. You have heard make your money work for you so many times, it stopped meaning anything. Here's the part nobody ever adds. The average American earns $2.4 million over a 40-year career. The average retirement savings at the end of those 40 years is less than $100,000. At the average cost of living, that runs out in under 4 years. That is not a discipline problem. That is not a spending problem. That is an explanation problem. Nobody showed most people what happens to money that gets placed into the right machine and left there for 40 years versus money that just passes through and disappears. This video explains exactly what that machine is, how it works, and the one setup that separates the people who build real wealth from the people who just participate. By the end of this, you will understand the specific mechanism behind every major fortune ever built without a lottery ticket or an inheritance. Not luck, not genius. One machine running for decades. Here is what investing actually means. Investing is buying a piece of something that earns money on its own, so you become entitled to a portion of what it produces. This matters because most people have it backwards. They picture investing as buying a number and waiting for it to go up so they can sell it to someone else at a profit. That is trading. It is a completely different game, and most people who play it lose. Investing is not gambling on prices. It is ownership. Picture this. Your neighbor opens a laundromat with $400 of their own money. First year, the laundromat generates $12,000 in profit. You own 25% of it. You walk away with $3,000 without ever touching a single machine. Your $400 became $800, not because someone agreed to pay more for your steak, because the business served real customers every day and you owned a piece of what it produced. That is the entire model. Scale it up, and that is a stock. Apple generates close to $100 billion in profit every single year. If you hold shares, you own a fraction of that proportional to how much you hold. You own a percentage of an earning machine. The machine runs whether you show up or not. The key point is this: you are not buying paper you hope to sell before the music stops. You are buying ownership in something that produces real earnings. The price rises because the underlying business became more valuable. That is real, not just opinion. And there's one specific collection of those machines that most investors ignore for years while chasing individual companies they barely understand. Here is what that machine actually is. The S&P 500 is a list of the 500 biggest companies in America: Apple, Microsoft, Amazon, JP Morgan, Visa. When you put money into an S&P 500 index fund, you buy a tiny ownership stake in all 500 at once. One purchase, every single one. This matters in a way most people never consider. 30 years ago, the top companies on that list were Sears, Eastman, Kodak, and General Motors. Look at that list today. Almost none of them lead it anymore. The companies at the top right now were either small or did not exist in 1995. Nobody predicted which ones would win. Nobody had to. The index automatically removed the companies that fell apart and replaced them with stronger ones. The machine is self-correcting. Kodak invented the digital camera and still went bankrupt. Nokia dominated mobile phones and missed smartphones entirely. Neither collapse cost index fund investors a permanent loss. You owned the entire race the whole time without ever having to pick the right horse. That machine has returned an average of 10% per year for the last 100 years, through the Great Depression, through every war, through the 2008 financial crisis, through 2020, every decade up. But here is where most people stop following. Being in the machine and actually capturing what the machine produces are two completely different things. Most investors are technically invested right now and still miss most of what the market returns every single year. And the cause has nothing to do with which stocks they hold. Here is what actually costs people their returns. Over a 20-year period ending in 2022, the S&P 500 returned roughly 10% per year. Researchers tracked what real investors actually earned in that same market during those same 20 years. The average equity investor earned 3.5% per year. Same machine, same 20 years. A 6.5% gap every single year. Put that in dollars. 10% compounded for 20 years turns $10,000 into $67,000. 3.5% over the same period turns $10,000 into $19,000. Both people were invested the entire time. One of them just kept making decisions. Here is that decision. The market drops 20%. This happens every 3 to 5 years on average, but it never feels routine when it is happening. Your account balance falls. Every financial channel on television is using the word crisis. Your phone shows you the number where your money used to be, and your brain fires one very clear signal: get out before this gets worse. So most investors sell. This is not a weakness. This is not something smarter people do not experience. This is a feature of human biology called loss aversion. Your brain registers potential financial loss as roughly twice as painful as an equivalent gain feels good. Ancient wiring. It evolved to protect you from physical danger. In the stock market, it costs you 6.5% per year. After selling, most investors wait. They watch the charts. They look for the moment it feels safe to get back in. When the market recovers and starts climbing again, confidence returns. They buy back in at a higher price than where they sold. Buy high, sell low. Repeat that enough times inside the best returning asset class in modern history, and you still come home with a fraction of what it produced. The machine worked the whole time. The investor kept interrupting it. Here is what happens to money when you stop interrupting it. You invest $10,000 at 10% per year. You never touch it. You never add a dollar. You do nothing. After 10 years, $25,900. After 20 years, $67,200. After 30 years, $174,400. After 40 years, $452,600. Look at the last jump. From year 30 to year 40, you gained $278,000 in 1 decade. On the same original $10,000 with nothing added. The first decade produced $15,900. The difference is that the base had grown so large that each percentage point now represents an enormous absolute dollar number. This is an exponential curve. It looks completely flat at the start, which is exactly why most people quit during the only window that builds everything that follows. They put money in, see almost nothing happen for 2 years, and decide it is not working. The machine is working. They're just not far enough into the curve yet. Now, start that same $10,000 at 35 instead of 25. Same 10%, same machine. At 65, you have $174,000 instead of $452,000. You did not invest less. You just started 10 years later. That difference in starting date cost you $278,000. Time inside the machine is the only variable that cannot be recovered. Warren Buffett became a millionaire at 30. He became a billionaire at 56. His net worth today is over $120 billion. 99% of that was accumulated after he turned 65. Not before, after. Not because he found better stocks late in life. Because he had been running the machine for over 50 years and the base had grown large enough that each additional year now produced billions on its own. He never stepped off the curve. Every investor who sells during a crash steps off it. When they buy back in, compounding restarts from a smaller base at a later point. The price eventually recovers. The years they lost do not come back. That gap is permanent, even after the account balance looks whole again. The key point is this: compounding does not reward intelligence. It rewards one thing: staying in long enough for the back half of the curve to do the work. But staying in only matters if you are in the right thing, and most investors make this far harder than it has to be. Here is why picking individual stocks is almost always the wrong game. Professional fund managers are paid millions of dollars per year to find investments that will outperform the market. Teams of analysts, direct access to company executives, data infrastructure that costs more annually than most people earn in a lifetime. Over any given 10-year period, researchers have ever measured roughly 80% of those managers underperform a basic S&P 500 index fund. Not occasionally, consistently, across every 10-year window on record. The reason is not incompetence. The market prices in what professional analysts know almost the moment that information becomes available. Hundreds of professionals act on the same new data simultaneously, and the price adjusts in milliseconds. By the time you read the headline, the edge is already gone. Nobody consistently beats the market. Not even the people whose entire career is dedicated to trying. The smarter play is to stop competing in that game entirely and just own the whole race. When a company in the 500 collapses and gets replaced, you already own the replacement. When the next dominant company appears, you already own it. You did not need to predict anything. Here's the part most people who know Warren Buffett have never heard. His will instructs that 90% of the inheritance left for his wife be placed into a single low-cost S&P 500 index fund. The man, considered the greatest stock picker in history, told the people he loves to stop picking stocks. The key point is this: you do not need to beat the machine. You just need to be in it. Here is the number that changes how you think about every crash you will ever see. If you were fully invested in the S&P 500 from 2003 through 2022, your annualized return was roughly 9.5% per year. If you missed the 10 best single trading days in that entire 19-year period, your return dropped to less than 5% per year. 10 days, 19 years, almost half your return gone. Those 10 days fell almost entirely within the worst stretches of the market. During the 2008 financial crisis, during the 2020 pandemic collapse, the exact moments when fear was highest and the most investors had already sold and were sitting in cash waiting for a sign it was safe to return. The investor who stayed in through all of it earned 9.5%. The investor who tried to time it earned 5%. 2008 dropped the market 37%, full recovery, and new highs by 2013. 2020 dropped 34% in 33 days. Finished the same year up 18%. Every single crash in the history of the stock market has been followed by a full recovery and new highs. Every single one. The The only investors who locked in permanent losses were the ones who sold while the market was down and bought back in after it had already recovered. Fear converted a temporary loss on paper into a real permanent one. Here is the behavior that closes the gap. Not a strategy, not a stock pick. One decision that removes you from the equation entirely. Set up automatic investing. Pick a fixed dollar amount. It does not need to be large. Set it to transfer automatically from your bank account into a low-cost S&P 500 index fund on the same date every single month. Then close the app. This works because the entire reason most investors earn 3.5% in a 10% market is that they make emotional decisions at exactly the moments those decisions cost the most. Automation removes every one of those decisions. You buy every month whether the market is up, down, or in free fall. When prices fall, your fixed dollar amount buys more shares automatically. When prices rise, it buys fewer. There is nothing left for the fear response to act on. The decision is already made every month. The strategy is boring on purpose. Boring is what decades of uninterrupted compounding looks like from the outside. Here is what you now know. 1. Investing is ownership, not gambling. When you hold a piece of an earning machine, that machine generates returns whether you show up or not. 2. The S&P 500 owns the 500 largest American companies simultaneously. It is self-correcting. When losers fall out, stronger companies replace them automatically. That machine has returned 10% per year on average for 100 years through every crisis that felt permanent while it was happening. 3. Most investors are already inside the machine and still earn less than half of what it produces. Not from bad stock picks, from selling when fear is highest and buying back after the recovery. Missing 10 days in 19 years cuts your return almost in half. The best days follow the worst days, every time. 4. Compounding is exponential. The first decade feels slow because it is. The last decade does most of the work. Starting 10 years later costs you more than the entire value of the first 30 years combined. That time cannot be recovered. 5. Automation removes the only variable that has ever actually cost investors their returns themselves. One setup, one monthly transfer, no decisions left to get wrong. Open a brokerage account today, not this week, today. Find a low-cost S&P 500 index fund. Set up an automatic monthly transfer in any amount you will not miss. Set the date, close the app. Every person who waited to start until they felt ready spent their whole life waiting. You now understand exactly how it works. The only thing left is to start.